Okay, thanks for joining us for another series of our trade recap. Now what we're going to do is provide this video in three parts. The first part we're going to go over is the trade that I had actually posted up on our Facebook on March. It was actually a strangle swap on crude oil. We're going to take a look at how that actually came together and going through that in steps. The second video is I'm going to take a snapshot of what we're doing for the current day. Again, the similar type of trade on crude oil. And the last video, or third video, is going to be with both myself and Paul Forcione. We're going to take a look at that current situation, and we're going to go forward with that where Paul's going to go and take a look at different scenarios based on how we've arranged that trade. Now, as with all our videos, feel free to pause and read the risk disclosure if you need. Okay, so let's move on here. Let's go over a few steps before we actually get started with our trade recap. Now, I know some of the comments that I've received is that our trade recap videos are pretty short, it's to the point, it covers a lot of stuff, and it does it in too short a time. If you're looking for more steps and information, what I'd like to suggest is that you go to our website over at wahoocapital.com, and over there is where you'll find a lot more information in terms of the how-tos, the videos, the classes that we offer that'll walk you through things step by step. What our trade recap is really designed to do is to show you some of the advanced strategies that we do cover in our classes and to kind of give you a sense of where things are in terms of benefits. Okay, so let's move on to our trade recap. So this is what we're going to be doing. We're going to be looking at a delta neutral trade called a strangle swap, specifically on crude oil. And the benefits that this type of trade structure does is that it allows you to take more of a longer term view to the markets. It's really insensitive to short term market direction, so you're not going to have to be glued to your computer doing any type of day trading. The other thing is that it gives you a wide range of prices to profit from. So again, you could be taking a look at this just a couple times a day as opposed to being glued to your screen every second or every minute or every tick. There's very minimal risk, so again, with a longer term view, you're able to manage this trade. The other thing too is that it's adjustable. We'll see where we initially put on this trade with the expectation that the market's going to run up over a range of prices, and when in fact the market actually runs its way down, we do have a lot of time to go ahead and adjust our trade as opposed to what a day trader would experience. The last thing here is that this type of trade structure does incorporate a theoretical edge in relation to volatility. Now, please bear in mind for this trade recap that this type of trade structure is something that we typically cover in our private group sessions as well as in our more advanced videos. So if you need to review our basic videos or basic how-tos, again, I would suggest strongly to take a look at those basics from our website. Now, this was the trade recap or summary that we had back in early part of March, or actually the end of February. I had something on gold. We're not going to take a look at that. We're going to look specifically on this type of trade that we have here for crude oil, or again, that was posted up on the Facebook. These were the specifications specifically for the crude oil contracts that we're looking at. And now moving forward to the recap. All right, so let me first start off by giving you the basic concepts on what we're doing. When we went ahead and put together this strangle swap structure, which is selling a series of calls and puts, this black line basically outlines the P&L chart of what that accomplishes. In other words, when we put those trades on with the options, it basically created this type of P&L formation where if the price of the underlying crude oil contract was between the range of 102 and 106, we would actually earn a profit so long as price remains somewhere within this range between 102 and 106. Now, if price were to fall below 102, what we were going to do is an adjustment, in which case it would create this purple formation, and mainly what that would accomplish is we would then adjust our profit objective to be somewhere between the underlying price of 96 to 102. Okay, so as you can see, what we're doing is we're starting off looking to profit between a range of prices, and if price were to drop on the underlying below the lower limit over here, we would do what's called an adjustment and create a new area to profit from. Now, before I go back into the technical aspect, let's take a look really quickly. This is the Facebook page we have, and if you were to scroll down, somewhere around here, you'd see one of my past posts over here. This basically shows you an illustration of what actually happened in the course of us planning this trade then. This was the type of structure from this initial trade that we had on here. Okay, so you could see over here, this was the real structure where if price were to drop below a given area, in this particular case after the trade was put on, it was roughly around about 150, I think we had it over here at the time, was where if it were to come down to this level, we would look for an adjustment. So this is a daily chart of crude oil, and looking back here, really what had happened was the price was really running its way up. It broke below this trend line here, and it fell close to support, and right around this area is really where we made the call for an adjustment, just for the fact that there was a possibility of price running its way back up from retracement. But on this level, or this particular day over here, is where we actually ran the adjustment. And you could see really where the market did run its way down. When we did the adjustment, and that adjustment refers to the purple schematic that I showed earlier. In fact, I'll just show it here to make it clear. But what happened was, as price moved its way down to this area, we basically did what's called an adjustment, where we looked to close a given position and we sold and opened a new position. And that created this purple schematic to where we adjusted this range of where we're looking to profit to this range down over here between 96 and 102. And that's this yellow shaded area that you see here on the chart. So it makes it easy to see. So if price stays somewhere within this range on the chart, we know we're basically yielding a profit. Okay, so this was the original end of day settlement prices back on the 21st, roughly whereabouts we put the trade on. And this is the end of day settlement prices on March 18th. Okay, so if we were to take a look at a quick summary, originally this was what we had done in terms of putting on the trade. And what that did when we started was give us a credit of 1.118 or 118 points. And again, if you're looking to understand a little bit more about what a debit spread is, what a credit spread is, how you earn and make profits or lose money if these things widen or narrow, again, I would strongly suggest going back to our videos for that. But in any event, this was the credit spread that we put on. And when we saw that price had fallen down to where we made an adjustment, what we did was we took this 108 call that we had originally sold here, we offset it by buying it back. And what we did also as a second phase of the adjustment was to sell a May 100 call at this price here. When we did this adjustment, it basically gave us a new spread credit to take a look at and monitor. So it was here at 350 as a credit. Okay, so in terms of the end of the day settlement prices on the 18th of March, it had basically whittled its way down to about 286 points here. Okay, so this is why you've got here a narrowing and a profit of 640 as it shows here. Okay, so again, this was the original schematic, and when we ran the adjustment, it came down here to the purple, which is the range that we saw over here. This is a snapshot of the execution platform, so you can see over here, this was the 19th, it was about 671 over here. This is the 20th, about 981. Okay, and this is the software over here that we use to basically model the spreads, called Option View. And again, we cover this in our classes as well. So if you'd like to learn things in terms of what a debit spread is, what a credit spread is, how to use the Napoli indicators, well, basically what you could do is go to our website. You've got the ACD-ROM, you've got Trading Option Visually, which is a book that's written by Paul Forcioni. You can use those as basic building blocks along with our tutorials in learning how those work. And then from there, what we do is we cover advanced strategies. And if you need more information in terms of more private sessions that tailored to your specific needs, you can take a look at our private group sessions. All right, so that wraps up our first video. You'll want to go ahead and take a look at the second two videos that we have. On our next series, what I'm going to do is take a look at the current market, where we're at. And again, we're going to go ahead and take a look at crude oil. And then in our third video, what we're going to do again is have Paul Forcioni and myself taking a look at various different types of adjustments that can be done as a matter of education